Welcome back to the deep dive. If you want the strategic story behind the latest results, well, you're definitely in the right place.
Yes, and today we're getting into TTK Prestige's Q2 for FY 2025-26. They're a huge name, obviously, in consumer durables, kitchenware.
Absolutely. And we've gone through their earnings call, the investor presentation, the usual sources.
Right. And the mission today is really to get under the skin of how they pulled off not just, solid double-digit growth, but also this really hefty margin expansion.
Yeah, especially given the economic background noise and that big regulatory change that hit them mid-quarter.
Exactly. It's that margin expansion that really jumps out.
It does. So total sales up 11% year on year, landing at Rs 796.6 crores. That's solid.
Solid, yes. But then operating EBITDA up 30.7% to Rs 100.5 crores. That's the story, isn't that gap?
It really is a huge difference between sales growth and profit growth.
And that's the core question, right? Is this jump sustainable?
Hmm.
Is it something structural they've achieved? Or was it just maybe a one-off alignment of factors?
Management seemed pretty clear, didn't they? They put it down to sustained effort, strategic choices around product mix.
Yeah, they pushed back hard against any idea. It was just sort of financial engineering. If they're right, it suggests a real shift in how they operate.
Okay, so let's unpack it. Context first. The global picture is still a bit shaky, but India itself seems to be holding up comparatively well.
That's absolutely key. You have to see it against that backdrop. India's domestic economy does seem pretty robust. You've got consumption holding up, decent investment, government spending.
And the RBI nudged up its GDP forecast for FY26.
Yeah, to 6.8%. So there's definitely a domestic tailwind helping companies like TTK Prestige.
But they're not completely immune to the global stuff, are they? The trade tensions, tariffs,
Yeah.
all that uncertainty.
No, definitely not immune. And you see it clearly in their numbers. Exports are still pretty subdued.
Oh, okay.
So right now, they're heavily reliant on that domestic engine firing. Makes their strategy within India even more critical.
Which neatly brings us to that regulatory curveball you mentioned, the GST change. It sounds complicated. Short-term pain, long-term gain.
That's a perfect way to put it. The GST rate on cookers and cookware, which is about half their portfolio, mind you, was cut.
From what to what?
From 12% down to 5%, that kicked in on September 22nd. Long term, that's obviously good news. Simpler taxes should eventually boost demand.
But there's always a but.
But the timing of the announcement, they announced it before September 22nd.
Ah, so everyone knew it was coming.
Precisely. So if you're a dealer, especially in general trade, what do you do in early September? You stop buying, right? You wait for the lower tax rate.
You run down your inventory.
Exactly.
Right.
So it created this weird temporary dip in sales just before the quarter ended because the channel partners just held back.
Okay, hold on. So they hit 11% overall growth, even with their dealers deliberately slowing down purchases in the last few weeks.
Yes. That's what makes the underlying performance seem even stronger, doesn't it?
It really does. So where did that growth actually come from? Was it mostly just higher prices or actual volume increases?
Oh, overwhelmingly volume. They were quite clear on that. Somewhere between, say, 70 to 80% of the growth was just selling more stuff.
Right. They hadn't taken big price hikes recently.
No, limited hikes in the previous quarter. So this feels like genuine underlying demand.
Interesting. And which product categories were driving that volume?
Appliances really stood out, up 13.5%. Cookware also strong, up 12.5%.
Okay.
But the real strategic clue, I think, is in the small domestic appliances, the SDAs. Think, air fryers, fancier kettles, modern kitchen gadgets.
More premium end.
Exactly. They launched 51 new products, new SKUs in Q2 alone, and a lot of those were in SDA.
51. Wow.
Yeah, it signals a clear push towards premiumization. And crucially, that helps explain the big jump in profitability we saw. Higher margin products.
Got it. So the product strategy links directly to the financials, shift the mix, boost the margin. Makes sense. But where are people buying these premium items? Is it changing how they sell?
Oh, definitely. The channel shift is really picking up speed. E-commerce, quick commerce, those are what they're calling the hyper-growth channels.
What kind of growth are we talking?
Double digit. Around 20% growth in the first half for those online channels. They're faster, efficient, and often where consumers browse for those newer branded appliances.
What about their traditional channels, the local shops, the general trade?
Well, GT has been sort of flat historically for them, but it actually showed some moderate growth this quarter, about 3.5%. They said that was down to specific efficiency drives they've put in place.
Okay, so some life there too.
And CSD, the canteen stores department. For the military, that bounced back pretty strongly too. Double-digit growth there. So most channels seem to be doing okay or better.
But there's usually one area that's lagging, isn't there? Where's the weak spot?
It's still the MFI-driven rural segment. Sales through microfinance institutions, that continues to be a drag.
Why is that? Still facing issues?
Yeah, a mix of things. Regulatory hurdles, difficulties with financing for customers, and some lingering effects from earlier income problems in rural areas. Management isn't expecting a quick turnaround there. They're quite cautious.
So that segment needs stability and credit flow, which isn't quite there yet.
Huh?
Okay.
Yeah.
While they're pushing the premium SDA, they also seem to be hitting the other end of the market pretty hard with their Judge brand, right?
Yes, the Judge strategy seems to be, frankly, a huge success for them. It targets the mass market, the value end.
And the growth.
Explosive. Over 50% growth in Q2. Sales hitting maybe 25 to 30 crores for the quarter.
50% is huge, but it's still a smaller base compared to the main prestige brand, isn't it? Is there a risk there? Like, are they stretching themselves too thin, maybe diluting the premium prestige image by chasing the value segment so hard?
That's the classic strategic dilemma, isn't it? How do you play at both ends? Management seems to view Judge as a completely separate vehicle.
A flanker brand, sort of.
It's exactly. To capture market share where prestige, just because of its price point, can't really compete effectively. So far, they say Judge is profitable, it's self-sustaining, which suggests they're managing to segment the market okay without Judge eating into prestige sales too much. It lets them protect prestige margins while grabbing volume with Judge.
Okay, that makes strategic sense. Let's circle back to those margins then. You mentioned the product mix, the premiumization, helping gross margins in Q2. But what's coming down the track? There were warnings about raw materials, weren't there?
Yes, definitely a flashing light there. Q2 benefited from that big shift and maybe some earlier cost savings. But management was very clear. Raw material costs, especially aluminum, were trending up consistently through Q2.
And aluminum is critical for them. Cookers, cookware.
A huge input. So what does that mean for Q3 and beyond? It means those strong Q2 margins are definitely under pressure.
So costs are rising now.
Costs are rising, and there's always a lag before they can realistically pass those on through price increases without hurting demand, without hurting that volume growth they just achieved.
Did they do anything to prepare?
They mentioned some strategic buying, trying to lock in prices maybe to soften the blow. But the expectation is definitely for Q3 margins to be lower than Q2's peak. It's that inflation management game again. That'll test them.
So good execution now, but a tougher cost environment is coming. That means they need to work on two fronts, right? Cut costs internally, but also keep investing for the future.
Precisely. They talked about optimizing the cost-based manufacturing efficiencies, supply chain tweaks, but also improving how they work with channels e-com, the big retail stores.
And crucially, they're still spending on those soft investments.
Yes, things like brand building, developing internal capabilities. That actually reduces the reported EBITDA figure now.
How much are we talking?
They spent about RDC 17.9 crores in Q2 on those areas. It's an intentional hit to current profits.
Why do that now if costs are rising?
Because they see it as essential groundwork. They expect these investments to pay off over the next, say, year and a half to 2 years, with better growth and stronger margins down the line. It's about building long-term strength.
Investing through the cycle, basically. And that investment approach shows up in their physical store expansion, too. They're still opening new prestige-exclusive stores.
They are. Added another 25 stores just in Q2. That brings them up to 701 exclusive outlets.
Wow, still aggressive expansion. Where are they targeting?
It seems to be a mix, filling gaps in the big cities, but also pushing quite hard into those growing Tier 2 and Tier 3 towns where you're seeing rising incomes and aspirations.
And they have the money to do this.
Oh, yeah. They're sitting on a strong cash balance over our risk, 785 crores. And they've started spending on planned capacity expansions, too, like for their cooker factory. About 30 crores spent in the first half on that.
Okay, so the core domestic business looks solid, investing for growth, but facing cost headwinds. What about the smaller parts, the subsidiaries? Ultrafresh, the modular kitchens business. Growing fast, but losing money.
That's the picture. Ultrafresh sales were up 23.5% in Q2. Good growth. But the EBITDA loss actually widened a bit to about Rs 2.1 crores.
Is management worried about that loss?
They seem remarkably patient, actually. They keep framing it as a startup investment. They say the losses are necessary right now because they're scaling up, hiring people, putting systems in place, training. It's all about getting ready for a much bigger market later. Future CL over current profit.
Interesting. A very different story, though, for their UK subsidiary, Horwood.
Yeah, stark contrast. Horwood is really struggling with the UK economy. GDP growth is soft there. Lots of uncertainty for consumers.
So what's the strategy for Horwood?
Survival, essentially. Focus heavily on online sales, manage costs very tightly.
Hmm.
They just about broke even on EBITDA in Q2, but it sounds like a really tough, fragile situation over there.
Really highlights the difference between the domestic Indian market and the global picture right now.
Absolutely.
Okay, so if we boil this all down from our deep dive into TTK Prestige's Q2, what's the main takeaway for someone listening?
I think the core story is really about strategic execution in the face of mixed conditions.
Mm.
They managed to handle that short-term GST mess. They're navigating ongoing issues in rural and exports.
Mm.
And they did it by really doubling down on higher margin products, especially those SDAs, and pushing hard through the fast-growing channels like e-commerce. They proved they can drive both volume and margin, at least for now, through smart product mix.
So successfully executing that premium push, managing the dual brand strategy with Judge, but now staring down the barrel of that raw material cost increase.
Exactly right. Which leads us nicely to that final thought, something for you to chew on.
Okay, let's hear it.
Well, look, this strong domestic growth is really leaning heavily on appliances and SDA right now. Management themselves have talked about how hard it is to just, magic up huge, efficient supply chains in India overnight to replicate what exists elsewhere, like China.
Right, building that ecosystem takes time.
Yeah, it takes a lot of time. So given that reliance, maybe partly on global or complex supply chains, and knowing these raw material costs are biting, how effectively can TTK Prestige keep pushing both premium and value, manage these cost pressures, and simultaneously build out a more robust, resilient domestic supplier base long-term, one that maybe insulates them a bit more from global price swings?
That's the billion rupee question, isn't it? Balancing short-term execution with long-term strategic resilience, especially in manufacturing.
That's the challenge that's going to define their next few years, I think.
A perfect place to leave it. Thanks for walking us through that. Really insightful.
My pleasure. Thanks for having me.